You often ask, does smart money logic work on crypto? And how can strategies such as order flow, working with liquidity and zones of interest be applied specifically to the cryptocurrency market? That's why I decided to make this video where we'll break down trading specifically on crypto. I'll show you how to use order flow, how to read charts so you can see how algorithms work, not just candles on a screen. And most importantly, how to find trades that actually make money. It's important to understand that cryptocurrency is different from Forex or the stock market. Volatility is higher here. Oversweeps often occur, and movements can seem chaotic, but the algorithms remain the same. If you understand their logic, you can trade Bitcoin and altcoins as systematically as any other asset. Let's move on to the Bitcoin chart. The first thing you need to understand when you are looking at any market is where the price is heading and what triggers could lead to a trade. We can see a downward movement on the chart. For me, this immediately means a priority towards shorts. I can only consider a long position if there is serious confirmation and only for local targets. The Asian session brought an aggressive drop, and on the higher time frame, the price stopped in the imbalance zone. This is a key point. On the one hand, we are already in a zone from which the market can react upward, but on the other hand, the context remains short. In such situations, you need to be able to work in both directions, understand where to look for short opportunities, and where you can open long trades. So let's take a closer look at this day. We'll analyze it step by step so that you understand how to correctly build a scenario and open trades in such conditions. The chart shows that the London session didn't work with liquidity at all. The price remained in a sideways trend without a clear direction. In such a situation, before the opening of New York, I marked two key liquidity zones for myself. Then I watch how the price will react to these zones. For purchases, I wait for liquidity to be removed and a clear reaction, a reversal with the formation of order flow. For shorts, the conditions are the same. Removal of liquidity, a confirmed reversal, and the appearance of order flow on the chart. Only in this case does the scenario become workable. Now let's move on to the New York session. Here the market removes the very liquidity that we marked before and starts to reverse. It's also important to highlight the imbalance zone remaining on the chart. To open a trade, you need to wait for a change in structure. In this scenario, the entry will be after the price returns to the imbalance zone. But there is a second way. If you understand how order flow works, order flow is formed when a local liquidity withdrawal appears on the chart, followed by a continuation of the movement. You can only work with it after two confirmations. On this chart, we see the first confirmation. The price removes liquidity, reacts to the zone, and continues to move. Then the second confirmation appears. Again, local work with the zone, and the market maintains its direction. And on the third confirmation, we wait for the scenario to remain intact and the price to continue falling. This is where you can open a sell trade. In this situation, the stop is placed behind the candle that worked with liquidity. The take is placed on the liquidity zone that we identified at the very beginning. Understanding order flow gives us additional confirmation of the liquidity that the price is currently reaching, just as we have just discussed. First, work with liquidity, then confirmations, and only then entry. I focus on confirmation for a reason. Look at the chart. After this liquidity was removed, you could have thought about buying, but order flow was not forming here. We see a simple upward movement without working with local liquidity. Moreover, there was no change in structure before the price filled the imbalance zone. This is a key point. On this day, there was no confirmation for opening long trades. Therefore, the most logical decision is to switch your attention to the London and New York sessions. If the order flow is not running in the long direction, then there is a possibility that it will appear in the short direction, already moving towards this liquidity. Nothing interesting happened during the London session, but in New York, the market began to work with London's liquidity, swept it away, and reversed. Further, the logic is the same as before. We are looking for additional confirmation. If there is any, the scenario becomes viable. In this case, everything went according to the rules. First, there was a change in structure, right here. After that, the price tested the zone of imbalance and reacted. This is already the first signal. Next, the first confirmation of order flow appears. The price worked through local liquidity and continued to move down. Then the second confirmation, then the third. And in each case, the market again worked with liquidity and confirmed the true direction. After the third confirmation, we wait for the movement to really consolidate downwards, and only then we open a sell trade. Stop behind the candle that worked with liquidity. Take on the liquidity withdrawal of the current day. The next day, I decided to record one of these trades. Now you can see exactly how I opened it, where I placed the stop, and where I fixed the take. It's important for you to understand that everything I'm talking about is what I use in my real trading. This is not theory, but specific actions on the chart. Now let's take a closer look at why I decided to enter the trade at this particular point. On the higher time frame, you can see how the market repeatedly drew liquidity from below and reversed upward, but above, liquidity remained untouched. I opened the chart at the end of the Asian session. There, the PDL, the previous day's low, had already been withdrawn, and a reversal had occurred. This was the first signal that it was time to start looking for confirmation for purchases. Then the first confirmation appeared. The market showed that order flow could be active, but that wasn't enough. I waited for additional signals. When the London session opened, the price gradually withdrew the local lows of Asia, and at that moment it became clear the upward movement was continuing. After that, I opened a buy trade. I set the stop behind the candle that worked with liquidity and the take profit at the upper liquidity zone. As a result, the trade brought in about $11,000 for just one entry. But the most important thing is not the amount, but the fact that the trade was opened strictly according to the rules and only after confirmation. But I know that many people find it difficult to learn how to read liquidity and confirmations right away. That's why there is a tool that makes it easier to get started, the OWL indicator. It has only one clear entry, zone, stop, and take profit. Everything is according to the trend, without complicated markings. It works equally well on crypto, Forex, and the stock market. Important, OWL is not related to liquidity and smart money. It is a separate approach, trend-based, with strict risk management. Following OWL's signal, I recently made a trade on Ethereum that brought in about $11,000. And to make the process even easier after purchase, I will send you OWL Helper, an expert advisor that automatically calculates stops and takes, helps you place trades correctly, and saves time. The link to the indicator is in the description. To get OWL Helper, just message me on Telegram. Hello, send me the OWL Helper expert advisor. I bought the indicator and the date of purchase. To help you understand exactly how to work with order flow, let's analyze another session on the same chart. I didn't trade on that day, but this particular trade was actually the simplest and most straightforward of all. The first thing to pay attention to is liquidity withdrawal. It has already happened, so we can look for confirmation to enter a short position. The price initially reversed, but order flow was not triggered, after which we see an oversweep. Then the market starts to fall, and here we see confirmation that order flow is indeed active. Here is the first withdrawal of local liquidity and a continuation of the downward trend. Here's the second, and here's the third confirmation. After that, you can open a sell trade, but the process doesn't end there. Further confirmation appears. Another one here, another one a little later. And each such confirmation gives you the opportunity to enter a trade because you understand where the market is headed. For trades, I use EVDEX, a decentralized exchange where you have complete control over your funds. There are no intermediaries, no account freezes, and no KYC. You simply connect your wallet, MetaMask, Trust Wallet, or others, and trade directly from your balance. Commissions are lower, the speed is high, and the interface is on par with the top centralized exchanges. And for those who know how to manage risk, there is leverage of up to 100x. It's a fast and convenient tool for active traders. I'll leave a link to EVDEX in the description. In order flow trading, everything is based on a clear sequence. First, the market must remove liquidity. Without this, the movement is not yet ready. Liquidity is always the trigger for the algorithm. Only after that, we start looking for additional confirmation. This is working with local liquidity, price reaction. Each such confirmation is a step that shows that order flow is indeed active. When you have a target, liquidity removal, and at least two confirmations, you have a trade. Remember, the market always solves its own problem. And if you read the algorithm correctly, you work with it, not against it. If this video helped you better understand how to use order flow on crypto, please put a like, write in the comments what strategies you want me to analyze next, and subscribe to the channel. There will be even more practical examples and analyses of real trades ahead.